This is a discussion on managerial or cost accounting as it relates to calculating food cost. Now this is going to be a little bit more in-depth than a previous lesson. I'll leave the link in the description. But this is so important to a restaurant survival, and it's also important for accountants to know how to correctly calculate this for their clients. So let's first put an equation on the board for food cost. So food cost equals the food usage divided by food sales. And this is an important distinction because I've seen accountants and restaurant owners try to calculate their food cost by using food purchases. So the reason why this is a little deceiving, and I'll give a similar example to one we used in our simplified lesson, but if we have food sales of $10,000 this week, and during that same time period, we purchased $5,000 worth of food, this suggests that our food cost would be 50%. So this is a bit unrealistically high. It's not correct. So what in the restaurant industry, you're striving for about 30%. Now that might change. It might be a bit higher, maybe even a bit lower depending on your industry or the type of restaurant you're in. But for the most part, 30%. So if I'm an accountant and I go and I run these numbers for my client, I see that they've brought in $5,000 in invoices for food, but only had $10,000 worth of sales, and I go run up to them and say, you have 50% food cost. That's not going to be accurate. So food cost is about usage. And the other piece of it is food inventory. So that's the piece that this does not take into consideration. So keeping track of your food inventory is really important for a number of reasons, but not the least of which is calculating an accurate food cost. So if you're a restaurateur or a manager or a restaurant employee and you're not keeping track of your food inventory, you're not going to be able to get an accurate food cost percentage. And the reason I say that is this. So this food usage is really based on inventory. So usage equals our beginning inventory, and we'll put some numbers to this equation in a second. Beginning food inventory plus our purchases. So purchases are relevant, they're just not the numerator in our equation. So less ending inventory and this will give us our usage. And that is exactly what we plug into right here. So let's say in this example, and something similar to what I used in the simplified version is this. So what I did was, let's say this is our very first purchase of the year, and I have zero beginning inventory. But I purchased $5,000 worth of inventory. So at this point, I have $5,000 in inventory. But at the end of the week, I really want to see how much I had, the quantity on hand. So minus, let's say I had $2,000 worth of food inventory at the end of the period. Could be the week, the month. For this example, we're using the week. So that means 5 minus 2 is 3,000. So I used $3,000 worth of food to generate this $10,000 worth of sales. So putting that into my equation, we have food usage, 3,000, divided by food sales, 10,000. And that's going to give us that's going to give us a percentage that's much, much more accurate and a lot closer to our benchmark, 30%.